Title Private Credit Crunch. The next Lehman might be wearing a regional bank badge. Introduction. The tremors began quietly. A few bad loans here, a red day in regional banking stocks there. But beneath those surface ripples, something deeper is shifting in the credit landscape. Jefferies Financial Group's exposure to First Brands, an auto parts manufacturer that lost nearly $2 billion before filing for bankruptcy, may prove to be more than an isolated blunder. It exposed a growing fault line in the modern credit machine, the sprawling world of private credit and shadow banking. For years, this market was celebrated as a stabilizer, a nimble, yield-rich alternative to traditional lending. It promised efficiency without regulation, flexibility without fragility. But those same qualities now threaten to become the system's Achilles heel. What makes this moment dangerous is not just one failed borrower or one bank's losses. It is the way private credit, shadow lenders, and regional banks have become intertwined, an invisible web of exposure linking Main Street loans to Wall Street leverage. The thesis is stark. If contagion spreads, the next systemic event may not begin on Wall Street at all. It might start in the middle, among the regional banks that quietly hold the connective tissue of American credit. Section 2. The Anatomy of the Modern Credit Machine. A Shadow Banking Explained. Shadow banking, or what the industry now prefers to call private credit, is the financial system's parallel circulatory network. It performs the same function as traditional banking, transforming savings into loans. But it does so outside the reach of most regulations, without deposit insurance, reserve requirements, or public scrutiny. Since 2010, this shadow sector has grown from a niche market into a multi-trillion-dollar pillar of global finance. Private credit funds, business development companies, and direct lending platforms now provide loans to companies too small or too risky for conventional banks. On paper, it looks like innovation. In practice, it is leverage wearing a new suit. Here's the dynamic. Investors, pension funds, endowments, and insurance firms are starved for yield. They pour money into private credit funds promising 8 to 12% returns. Those funds lend to mid-sized corporations, often with light covenants, inflated valuations, and opaque collateral structures. The loans are then repackaged, sometimes repledged, and used to secure additional financing. The Jefferies First Brands saga exposed how fragile this can become. Jefferies acted as both financier and intermediary, extending credit to a borrower whose accounts and receivables may have been double-pledged. When the company imploded, the collateral vanished and the losses rippled outward. Private credit thrives on opacity, the promise that risk can be quantified without being truly seen. But when liquidity tightens, opacity becomes contagion fuel. B. Traditional banks' role in the chain. Traditional banks, the regulated spine of the system, have not been bystanders. They have become shadow enablers. Regional banks provide credit lines and repo financing to private credit funds. They offer warehouse facilities to package loans before they are sold or securitized. They participate in syndicated loans that originate from those same funds. In other words, the regulated sector and the shadow sector are two halves of a single organism. The difference lies not in function, but in disclosure. When a shadow lender fails, the impact transmits upstream through these credit conduits. A loss at Jefferies, for instance, does not end on Jefferies' balance sheet. It ripples into its partner banks, repo counterparties, and co-lenders. The illusion of separation between private and public credit is just that, an illusion. The arteries connect beneath the surface, and they all pump through the same liquidity heart, the U.S. dollar funding system. Section 3, Fault Lines and Fragilities. The modern credit system is vast, fluid, and sophisticated. But beneath its complexity lies a set of recurring weaknesses that always resurface when liquidity tightens. These are the fault lines where confidence can suddenly crack. A. Counterparty risk. Hidden in plain sight. Every financial crisis begins with a misunderstanding of who owes what to whom. Private credit's rapid ascent has layered risk through multiple intermediaries, investors, fund managers, warehousing banks, and borrowers, all tied together by leverage. This structure obscures counterparty exposure. A fund may appear diversified, but rely on the same bank for funding. That bank may depend on short-term repo lines collateralized by the very loans it helped originate. If one node in this chain breaks, The others are forced to mark down assets, margin calls multiply, and liquidity evaporates. In 2008, the failure point was mortgage-backed securities. In 2025, it is the opaque world of receivable-backed credit, loans collateralized by promises, not cash flows. The core danger: everyone thinks they are senior. When the music stops, they learn otherwise. B. Collateral illusion and mark-to-market reality. Private credit thrives on the assumption that loan values are stable until proven otherwise. Unlike publicly traded bonds, these loans are marked at cost or internal models, what investors call mark-to-model. That model works until it doesn't. When a borrower like First Brands defaults, lenders must revalue their entire portfolios. What looked like a $100 million performing loan might suddenly be worth $20 million or nothing at all. And when fund investors request redemptions, the problem compounds. You cannot sell illiquid loans at full value when the market has gone silent. This is what causes net asset value collapses, redemption gates, and fire sale dynamics, all of which can spread faster than the underlying defaults themselves. Valuation illusion transforms into liquidity reality. C. The liquidity mirage. For over a decade, abundant liquidity from central banks masked structural fragility. Near-zero rates made risk cheap, and cheap risk made leverage irresistible. Now, with interest rates near 5% and funding costs rising, the mirage is fading. Short-term borrowing, through repo, commercial paper, or unsecured funding, has become more expensive. Collateral that once seemed pristine, like corporate receivables or leveraged loans, is being questioned. When banks hesitate to lend to each other, the liquidity engine stalls. This is the moment where fear turns operational. Spreads widen, repo desks hoard cash, and smaller banks start feeling the oxygen thin. The illusion of liquidity, the idea that credit can always roll, evaporates first in the shadows and then in the daylight. Section 4. The Canary Chorus, Early Warning Signals. Every credit cycle hums before it breaks. The pitch rises quietly, a basis point here, a spread there, until the market realizes the sound isn't background noise, it's an alarm. The following are the early warnings, the canaries in the coal mine now fluttering in the credit system's dark corridors. 1. Funding market stress. When confidence begins to fade, the first signs appear in the plumbing of finance, the markets that supply overnight money. Watch these indicators. SOFOIS spread, the gap between the secured overnight funding rate and the overnight index swap rate. Rising spreads signal interbank distrust. FROIS spread, the difference between futures implied lending costs and swap rates. A jump means banks are pricing in future funding stress. Repo rates. If repo rates spike or become volatile, it means collateral is being questioned, a classic pre-crisis symptom. So far, these spreads have begun to widen modestly. Not panic, but tension. A small shift here often precedes a bigger fracture later. 2. Private credit and CLO markets. Private credit fund redemptions. Some funds have reported rising withdrawal requests, a sign that institutional investors are getting nervous. Net asset value suspensions. When funds gate redemptions or freeze NAV calculations, it means assets can't be fairly priced, an early form of liquidity freeze. CLO, collateralized loan obligation, spreads. Lower tier tranches rated BBB and BB have started to widen. The market is repricing risk on leveraged loans. This is the shadow sector equivalent of a bank run. Slow motion withdrawals from illiquid assets. Regional bank equities. The real-time pulse. The stock market has already begun voting with its feet. This chart shows how several U.S. regional banks have recently seen their share prices fall, reflecting growing investor concern about credit risk. Here's the breakdown in plain English. Institution, recent performance. Key risk. Western Alliance, AL, down roughly 9%. High commercial real estate and private credit exposure. Zions Bancorp, down roughly 10%, rising charge-offs on commercial and industrial loans. Comerica, CMA, down roughly 4%, corporate deposit flight and rate sensitivity. KeyCorp, down roughly 4%, small business loan exposure. Citizens Financial CFG, down roughly 4%, mid-market and real estate lending stress. This synchronized drop suggests a market repricing of credit risk, not isolated weakness. It signals that investors believe the next fault line runs through the regional layer, not the megabanks. 4. Credit derivatives and volatility indices. Credit default swaps on Jefferies, Citi, and Goldman Sachs are showing modest but noticeable upticks. The cost of protection is rising. The MOVE index measuring bond market volatility has remained elevated. The high-yield option-adjusted spread is creeping higher towards stress thresholds near 550 basis points. When credit and volatility move together, it means markets are preparing for impact. 5. The voices of warning. Even the veterans have begun to speak cautiously. Jamie Dimon warns that private credit is growing in the dark, calling it one of the underappreciated risks in the system. Jim Chanos, who exposed Enron, compares today's layered private credit structure to 2008's subprime web, too many intermediaries between capital and consequence. Howard Marks of Oaktree notes the excessive optimism in private lending deals, a hallmark of late-cycle behavior. The chorus is forming. The voices differ, but the melody is the same. The risk you can't see is the one that gets you. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 5. The domino chain. From Jefferies to the regionals. Every financial crisis has a chain of custody, a sequence of exposures connecting the origin of the problem to its ultimate point of failure. In 2008, that chain ran from mortgage originators to Wall Street securitizers to global investors. In 2025, it runs from shadow lenders like Jefferies to mid-sized corporate borrowers to regional banks and finally to Main Street liquidity. A. The first domino, Jefferies and First Brands. Jefferies' exposure to First Brands, an auto parts manufacturer, is more than a single corporate loss. It's proof of systemic opacity. The company allegedly misplaced or never properly received about $1.9 billion in borrowed funds. Lenders accuse it of rehypothecating collateral, pledging the same receivables to multiple creditors. When it went bankrupt, the recovery value of those loans collapsed from billions to nearly zero. Jefferies' stock fell more than 30% in weeks. That decline wasn't just punishment. It was the market saying, "We don't trust your book values anymore." This is the Lehman prelude moment, when counterparties begin questioning not the transaction, but the institution itself. B. The transmission layer. Regional banks' exposure. Regional banks such as Zions, Comerica, and Western Alliance sit at the next link in the chain. Their connection to the shadow system is subtle but critical. They lend to or co-finance with private credit funds through warehouse lines. They serve as lenders to the very companies those funds finance, creating overlapping exposure. They rely heavily on confidence-sensitive funding, such as uninsured deposits and wholesale borrowing. When a private credit borrower defaults or a fund takes losses, the perceived value of similar assets on bank balance sheets declines. That perception drives down stock prices, which in turn increases funding pressure, a self-reinforcing cycle of fear. If Jefferies' balance sheet becomes suspect, so too does the entire mid-tier banking ecosystem that mirrors its exposures. See the reinforcement loop. Feedback between markets and banks. The process unfolds in 3 phases. 1. Credit event. A borrower default or fund loss triggers valuation uncertainty. 2. Market reaction. Bank and fund equities fall, credit default swap spreads widen, funding costs rise. 3. Liquidity contraction. Institutions hoard cash, lending slows, and borrowers face refinancing stress, leading to more defaults. This is the credit spiral, not a single crash, but a recursive tightening that feeds on itself. It's slow enough to deny, but fast enough to destroy balance sheets before policymakers can intervene. D. The policy bridge. What the Federal Reserve can and cannot do. The Fed has tools, repo facilities, discount windows, and emergency programs like the Bank Term Funding Program. But private credit operates largely outside those safety nets. When shadow banks seize up, liquidity support doesn't reach them directly. That's why the pressure bleeds into the regional system. It's the interface between the insured world and the unregulated one. If that bridge fractures, the Fed faces a dilemma. Either extend support to non-banks, inviting moral hazard, or let defaults cascade, risking systemic failure. Either path is dangerous. Both erode confidence in the system's integrity. E. The present tense. As of now, we are somewhere in the middle of that chain reaction. Jefferies has taken the hit. Regional banks are wobbling, private credit funds are facing redemption requests, repo markets are still functioning for now. The dominoes are lined up. They haven't all fallen yet, but you can hear the first one tipping. Section 6. Systemic implications. The immediate losses may be manageable for now. The deeper problem is structural, the way credit, liquidity, and confidence interact. 3 transmission channels matter most. 1. Financing becomes scarcer and costlier. Refinancing risk. Higher base rates combined with wider credit spreads create a double squeeze. Weaker borrowers fail first. Stronger borrowers survive but delay projects, refinancing at punitive terms. Liquidity preference. Lenders begin hoarding cash. They shorten maturities, demand tighter covenants, and avoid riskier credits. This starves marginal borrowers and slows business investment. Valuation resets. Private credit marks drift toward reality. Markdowns reduce fund net asset values, cut into risk budgets, and force position unwinds. It is not panic, but attrition, the slow recognition of fantasy valuations. 2. Transmission from shadow to regulated banking. Overlap of exposures. Regional banks hold commercial and industrial loans to the same middle market borrowers financed by private credit funds. Loss recognition in one silo pressures the other. Funding fragility. Falling bank equities raise the cost of unsecured borrowing. Deposits flow to higher-yielding money market funds, draining stable funding from banks. Capital constraints. Credit losses and rising risk weights compress common equity Tier 1 capital buffers. Boards respond by cutting lending, tightening credit right when the economy needs it most. 3. Real economy feedback. Small business first. Tighter lines of credit hit hiring, inventory, and investment. Suppliers extend payment terms and cash cycles stretch thin. Commercial real estate second. Refinancing cliffs meet higher interest rates. Net operating income cannot bridge the gap. Valuations fall and banks take provisions. Labor and demand. As credit tightens, layoffs follow. Slower wage growth feeds caution, which reduces spending, which further weakens loan quality. Even without a formal crisis, the result is clear. The credit impulse weakens. Growth slows. Volatility becomes structural. The system delevers, voluntarily if we are lucky, forcibly if not. Section 7. Scenarios ahead. The good, the bad, and the ugly. The coming months will determine how far this tremor travels. 3 possible outcomes frame the range. The good? Controlled burn containment. Losses stay ring-fenced within a few borrowers and funds. Stronger institutions absorb the weak through mergers and acquisitions. Targeted backstops. Central banks provide liquidity. Regulators push for transparency in private credit valuations and receivables finance. Outcome: a shallow recession or growth slowdown. Risk premiums normalize. Private credit consolidates into a more standardized, supervised form. The bad: credit drought. From crawl to freeze. More borrower failures lead to fund redemptions. Funds gate withdrawals. Secondary market marks slide. Regional bank indices grind lower. Bank retrenchment. Credit rationing becomes widespread. Commercial real estate impairments accumulate. Capital raises happen at punitive valuations. Outcome: prolonged stagnation. Unemployment climbs. Defaults stay high but contained. Policy support arrives late and uneven. The ugly? The Lehman echo. Break in the chain. A mid-tier bank or major non-bank fails to meet its obligations. Collateral chains snap. Counterparties pull lines. Plumbing seizes. Repo markets wobble. Fire sales cascade across leveraged loans, collateralized loan obligations, and credit ETFs. Outcome: a systemic panic. Emergency facilities announced over a weekend. A deep recession follows. Global regulators rewrite the rules of shadow banking. The probabilities depend on 2 things: the pace of loss recognition and the credibility of the response. The faster we face the losses, the better our odds of avoiding the ugly ending. Section 8. Conclusion. The collapse of First Brands, Jefferies markdowns, and the slide in regional bank equities are not random events. They are signals, the system repricing truth after a decade of cheap illusion. Collateral quality, counterparty reliability, and liquidity assumptions are all being rewritten in real time. The names attached to this moment frame the narrative. Jamie Dimon warns about risk growing in the dark. Jim Chanos sees too many layers between capital and consequence. Howard Marks calls out the excess optimism typical of late-cycle behavior. Opacity compounds errors. Leverage accelerates them. Whether this becomes a crisis depends less on balance sheets and more on belief. The willingness to roll funding, accept collateral, and trust counterparties. If belief holds, we get a controlled burn. If it frays, we get a credit drought. If it breaks, we hear the echo. The next Lehman may not wear a Wall Street badge. It may wear a regional one. Quiet, local, indispensable. That is why these early signals matter. They are not the end of the story. They are the part where the camera lingers on the fault line, right before the audience learns whether the bridge holds.